Happy February. I stress that because it's already the middle of February, and I still realize as I push record that my slides have January. That's okay. Let's get to it. All right, team. So here's what we got. Really good stuff. Rates still down, low sixes, almost touching those fives. We're getting close. You can see this is the 10-year treasury. So I'm switching this up. A lot of times I may show you the MBS chart. This is treasuries because this actually moves in the same direction. Look how much rates have improved just in the last, call it 2 weeks, give or take. I do think you see the three little greens, meaning things are going up. That's rates are going up the last 2 or 3 days. I think they're going to go up here another couple days just because that's just the trend. But overall, I think big picture, it's never a straight line. I think we'll get better here in the near future. Okay, I've seen a lot of articles on Austin, Texas being the worst, the slowest housing market right now. It's crazy. Pardon me. But it is crazy for days on the market compared to last year. Austin, you can see the blue is 2024, 2025 is the red dots. You can see where that is. Unfortunately, Dallas is number seven, not ideal. And you got San Antonio as number three. So you could call that Central Texas general, not the best place to be a homeowner right now. And just 7, 8, 9, 10, 11, 12. Is that like top 10 is Fort Worth, maybe? Maybe that's 11 or 12. Can't count. Along those lines, it's now taking Austin over 100 days to sell a home. Home prices are down 4%. So you can say, man, that's the worst in America. It's only down 4%, guys. They've also had some of the fastest appreciation. So let's keep things in perspective here as we talk about these numbers. So overall, things are good. But yes, Central Texas, not ideal. I think these are really good graphs. You can see Austin on the right, the chart that shows kind of just how much longer we're in the United States. The average time on the market is 60 days, which is still a normal and healthy market. So overall, things are good in the US. Not so good in Central Texas. Redfin has now added Chat GPT or is now embedded in Chat GPT. So if you're not working on being found on Chat, you're probably losing some business. I know we're working real hard. We do get found on Chat, not as much as I'd like. I'll admit we're doing some things from a marketing standpoint that I hope will improve, but I just think this is indicative of just where things are and what we need to do to stay with the changing times. The Fed is supposedly trying to get banks to do more mortgages. So banks are only about a third of the market, 35%. The rest of it's dominated by guys and gals like us, mortgage professionals like us. Quite honestly, I'm okay with them only doing 35%. I don't like them doing a whole bunch because quite honestly, just service isn't there. And I just don't like, if we lose to a bank, I'm like, come on, we're better than that. So home builder sentiments drop again. Still not doing well in terms of their feelings. I will tell you, I really think 2026 is going to be a good year for the real estate industry. So we'll see when the builders finally start feeling the warm and fuzzies. We've seen some traffic pick up in the last few weeks, but we will wait to see how that plays out. Buyers are walking away. So in San Antonio, I brought that up. It was the third worst, right? In San Antonio, 10%. In San Antonio, Texas, where people are walking away. Now, truthfully, I'm really confused by this chart because it says, the highest cancellation rates are in Georgia, Las Vegas, San Antonio. I've seen many stats, and we've looked at them here, where 16% of deals are getting canceled. So I'm not sure why these stats are so much lower. I'm encouraged by this, but it's better than the data we've seen as of late. Income needed to buy a home is falling. That makes sense, right? When interest rates have come down, like we've already shown you, it make sense. But the reason why I am showing you this, I'm really surprised just by look at 2020, like January 2020 on the left side of this chart. I would have thought that would have plummeted as far as income needed because rates went from pre-COVID, let's just say six down to three. Like, why is there not a big dip in there? So again, I go back to I'm citing the sources, right? So whoever data wrapper is, but the reality is, I'm like, I don't know. It feels like this graph should have a lot more swings. And I understand, again, this can go back up because once COVID prices, home prices went up 40, 50%. But I'm just not seeing that dip there for that few months in 2020 that I would expect to see. But overall, the whole point is Dallas affordability. Things have gotten more affordable with the rates as of late, 7.4%. Here's my proof, right? So Dallas is down there at the bottom where it's dropped in a good way, 7.4%. And what's interesting is Austin, Texas, the affordability, like we talked about, has dropped 5.7%. I think a lot of that's just because, again, the houses got 4% cheaper, so to speak. So Let's see. Product of the week, getting a ton of calls for home equity loans and refinances. Not a surprise, right? Rates come down. We got the most equity ever in America right now. So if you do need or want access to cash, this is phenomenal. Give us a shout. We're really good at them. And then some fun for the week. Let's see what we got. Spring market shows early signs of life. This isn't necessarily fun, but it's fun, interesting. So, meaning you can see just where we are in terms of the demand index. It's not where we want it to be in terms of year over year for the demand, but it does tell me that again, the month of supplies at 5%, or 5.4 months rather, I beg your pardon. The number of sellers, it's 47%. So one and a half times more sellers than there are buyers. So why is that good news? As rates have come down, I think rates will continue to be relatively stable, maybe tick down just a touch here in the second part of the year. And if rates, or pardon me, prices stay relatively consistent, right, not up or down, I think we're going to see some demand come out, and it's nice to see there's inventory that's getting built. I don't want a gluttony of them, but the reality is, it's going to be a good year. I'm gonna make it happen. I'm gonna manifest this. And then I thought this was funny. I remember the episode of Michael Scott and Jan, loan officer's version of lock float, lock float. You have no idea what your toll of watching the markets is going to do to me as a loan officer. It is funny because you got borrowers every day, but like, I saw rates went down. Right? Like, yes, they've come down, not by a ton, as evidenced by this week. They're moving like in this last big quote unquote big swing, zero point 0.1, zero point 0.2 in rate. But it is funny to just deal with the everyday consumer, as you know. Evidence of success. Shout out to the peeps. We love it. Thank you for always continuing to say good things. And if you want to leave good things, follow us on social. We love kind words. We love feedback and constructive criticism done the right way. And as always, we appreciate you. Hope you have a great and wonderful remainder of your week. And we will see you next week in February, not January, like the opening slide said. And remember, when you think mortgage, think Mark.